Happy Wednesday out there, folks. This is Darius Dale here to present our macro minute for Wednesday, July 27th, 2022. Starting with asset markets, we have stocks up this morning, commodities mixed, crypto up, dollar down, global bond yields mixed. Shifting to our market moving headlines, this is a rare case of watch what they say, not what they do. The Fed looks to hike rates by 75 basis points again today. That's priced in. And any surprise may roil markets or add a lot of fuel to the flame if they dovish surprise the 50 basis point rate hike. With no dot plot today, investors will parse the statement in Jerome Powell's press conference for guidance. For now, Fed fund futures are pricing in about 100 basis points more of incremental tightening this year. So if they sort of open the door for a September pause, that's very that would be bullish for risk assets because again, ultimately, that's not that outcome is not priced in. Again, we don't think they're going to pause in September, to be very clear on that, but certainly that's certainly a possibility. We talked about that in our leadoff morning note in terms of the volatility market setup vis-a-vis our crowding analysis. Very interesting setup, so definitely go check that out because it's not the typical setup you would see with respect to event vol. Et cetera, with around the FOMC. It is the typical setup, but it's very binary. It's extremely binary from the perspective of the vol setup and a lot of major U.S. equity factors, credit factors as well. Shifting gears, actual recessions are processes, not points. So futures were boosted by earnings cheer. The focus is on Alphabet, Microsoft, and Texas Instruments, which delivered double-digit revenue growth and optimistic outlooks. You got to juxtapose that with the news we heard out of Walmart and Shopify earlier this week. So there's clearly a bifurcation amongst companies in terms of the sort of speed with which the downside in economic activity is hitting their P&L. As you know, we talked about this. Mike Green over at Simplified was the first person to kind of really call this out a few months ago or a couple months ago, which was, if you go into recession, it's not like it's this single point in time thing that happens to every economic agent in the economy all at the same time. Company A might go into recession in month A or month one. 2 months later, company B might go into recession. It's the same for households as well. Higher income households may not even experience a recession. It may just be something that's congregated on the mid to lower end of the income spectrum. So again, the economy is not a monolith. You have to think about this from a distributional aspect. But overall, if you get a decline in output as a function of several sectors or large pockets of the economy declining, then that's ultimately what turns out to be a recession. Anyway, shifting gears, rate hikes are having their intended effect. Blue chip companies that need to borrow in the U.S. are increasingly relying on commercial paper. These are short-term IOUs. The amount outstanding has mushroomed to almost $1.2 trillion this year, up more than 20% from the lows in 2020. So this is, we're seeing, clearly investors have raised a lot of cash. If you look at money market fund balances, you look at reverse repo balances out of the Federal Reserve. So companies are seeing higher yields on sort of longer term debt, and they're shifting their financing to the shorter term. That's obviously going to come home to roost, though, if the Fed continues to hike rates for further and longer than investors are priced in. And then lastly, just kind of wrapping up what I've said there on the IG side, they're relying less on longer term debt markets with sales of high grade corporate bonds dropping about 7% in 2022. We know the U.S. economy is extremely financialized. You got about 70% of all private non-financial sector credit warehoused in the shadow financing sector. So that is definitely something we know this move in markets is actually having impact in terms of slowing growth, and we can see it through this credit market data. Big movers this morning. You have the S&P 500 up 1% to up 1% month over month. Got a lot more FOMO month over month in Ethereum, which is up another 7% to up 23% month over month. Shifting gears to our volatility adjusted momentum signals and probable ranges. U.S. dollar index bullish, right back at the lower boundary of its probable range. This would seem to suggest the currency market is anticipating a dovish outcome from the Fed. Again, if we do not get it, look out above for the dollar index for dollars relative to other currencies. Gold is bearish VAMs, getting towards the upper bound of its probable range, not quite there yet. 10-year nominal treasury yield bullish VAMs still at the lower bound of its probable range, been gripping that thing since late June. High yield credit spreads bullish VAMs. At the lower boundary of its probable range, sort of similar setup as well there. So a lot of the rate volatility that's come out of the fixed income market is spreading to the credit markets, which ultimately is having a positive impact on the equity markets in the near term. S&P 500 neutral VAMs towards the upper bound of its probable range, got another 2% upside to 40 spot 50 there, or roughly thereabouts. Fixed bearish VAMs in the middle of its probable range. NASDAQ 100 neutral VAMs got about 4% upside, 6% of downside there. Russell 2000 neutral VAMs towards the upper bound of its probable range, 2% of upside, 6-7% downside. Bitcoin bearish FAMs, you got 8% upside, 12% downside. Ethereum bearish FAMs, 7% upside, 26% downside. Shanghai Composite, that is neutral VAMs. You got about 2% of downside, 2.7% of upside, so somewhat of a fair fight there. Oil neutral VAMs, you got about 7% of downside versus 14% of upside. Riddle me this. If the Fed reflates stocks, what's to stop crude oil from going back to $120, $130 a barrel? I mean, this is, again, we all know the supply deficit. The bull case for energy and ag is a lot stronger than the bull case for stocks here. So why, if the Fed pivots in today or in September, is that not going to be extremely bearish for energy and ag assets, and kind of keep a very elevated floor under inflation, headline inflation readings, and ultimately a very harsh ceiling on consumer confidence readings, et cetera, et cetera. This is something that I don't think has been really discussed and debated by at-market participants, but they certainly will in the coming months, in our opinion. And then lastly, ag bearish FAMs bouncing alongside that. Again, this could be a very elevated floor under food and energy prices if the Fed does pivot too soon. We saw that out of Arthur Burns in the 1970s in response to the growth slowdowns. We saw basically three recessions in the 70s, early 70s, mid 70s, 73, 74, 73, 75, and then lastly, kind of the 1970. Really persisting, off and on through the early 80s. The reality is we have a variant perception that Powell does not want to be remembered as the next Arthur Burns. And ultimately that means they're going to tighten for longer than consensus expects, for likely further than consensus expect, both with the policy rate and with the balance sheet. So we'll see. And then lastly, industrial metals, bearish VAMs, that is 1.7% upside versus 8.9% of downside. So with that, Darius Dale presenting our macro minute for Wednesday, July 27th, 2022. I'm back on the Real Vision Daily Briefing this afternoon. So excited to unpack the FOMC right after that. So catch you back here at 4 p.m. on the Real Vision Network. Cheers.